Hello everyone. Today I would like to introduce you to our TradeAI platform, which includes two components. First, a methodology that allows you to look at financial markets and at option trading strategies differently from all other operators. Second, a series of tools built from scratch based on this methodology. Upstream of everything else, my goal is to present you our methodology in simple words without trying to explain all the math and the computer learning stuff involved in this platform. I firmly believe that the heavy work of data analysis should be done by the software, and that you as users should simply be able to visualize and exploit the results of the analysis. But at the same time, I believe that you as users have a responsibility to first understand the logic embedded in this methodology, and secondly, learn how to use the software and interpret the results of the analysis that is provided to you so that you can take the greatest possible advantage of all of the above in your trading. In the next few minutes, I will present you the methodology used to create the TradeAI tools and the logic behind the development of this methodology. And if everything I'm going to tell you sounds reasonable and compelling to you, then I urge you to take it to the next level and learn through our Quick Start package, which provides hands-on education, giving you access to the software and to a series of instructional videos. These videos will guide you through all functionality of the software, explain how you can interpret certain probability outcome, as well as how to build your own trades and what to watch in the process of doing it. You will learn how to take competitive advantage in your trading over those who are not using our tools. Ready to start? The whole methodology behind TradeAI is based on probability. And a question now could arise: why probability is so important? Sometimes we do not even realize that probability is determining our behavior. To make an example, thousands of car accidents happen every day. Millions of drivers and pedestrians are hurt in these accidents. Does it mean that we all have to live in an underground bunker and never ride a car or walk the streets? Of course, for most people, the answer to this question is no. They will continue to drive their cars and enjoy walking the streets, and they will not pay attention to these accident stories. And why happens this? Because they base their decision on their own experiences. And let's now for a second think of what experience actually means. Let's dive into what we understand as experience in a certain area of expertise. First of all, we need to define events that characterize this area, and then start collecting pairs of events and following outcomes. To put it very simple, this comes in, that comes out. The more of these pairs event outcome somebody puts together, the more experienced in this area this person is considered. Let's put all this into a real-life example. Parents always try to teach their children how to behave in certain situations. During their adult life, parents collect knowledge of these pairs of event outcome, and then they try to transfer this experience to their children, who might not be able to collect enough on their own to predict a right outcome. Now, let's think of what these pairs represent from the mathematical standpoint. It is actually building statistical distribution of the outcomes and then calculating probability of certain outcome to happen. The more representation of these pairs you have, the better the calculation of probability would reflect reality. So, our experiences are subconsciously created from our brain, collecting statistics of historical events. Decisions are then taken by weighing the different options and the probability of them to happen. Let's then go back to the question we left open a few minutes ago. What does experience actually mean? Simply, it is the ability of your brain to calculate probability of certain outcomes occurring and then comparing that probability to your tolerance level. If calculated probability is below your tolerance level, you will drive your car and walk the streets. You probably know people who are afraid to travel by airplanes. Airlines carry billions of travelers every year with relatively a few plane crashes. But for some people, their risk tolerance level is so low that they refuse to fly. What we just established is that probability and tolerance levels are two very important factors that in many cases define our behavior. In market trading, you are always forced to make a decision to either enter a new trade or to exit an existing one. Risk management is one of the most important factors that drives your decision. Our mission here is to provide a robust methodology along with specific tools meticulously crafted based on this methodology. Our goal is to empower you to conduct comprehensive probability analysis, enabling informed trading decisions rooted in calculated risk assessments. Today, let's also debunk the myth that trading, especially options trading, is inherently risky. The reality is that all forms of trading involve risk. It's an integral part of the game. Risk is everywhere in the market, and what matters is to learn how to manage it effectively. Nobody can predict the future movement of some stock unless they have some inside information, which is actually illegal. So, by buying or selling stocks, you are always opening yourself to unrestricted losses with just 50% probability of being right in your selection. Option trading gives you much more flexibility. Indeed, you can restrict potential losses or even reach some return if the stock moves against you. You can either take directional trades or non-directional ones independent from the stock movements. You can build trades given a high probability of success and a positive expected profit and loss, as we always do here at Trade.ie. Probability-based trading for most people is reminiscent of casinos, and casinos are usually associated with profit and success. Some traders think that using the same principles as casinos in their trading, they should be successful. This could generally be a true assumption, but here comes the $1 million question. Why then does probability-based trading not work for most traders? Why are traders losing money even though they are using the same risk measurement parameters as casinos? The answer is actually pretty simple. If you are basing your trading on the same proven principles as casinos, yet getting opposite results, it should be obvious that something is wrong in how you are applying the math to your probability calculations. Casinos are profitable because they know the distribution of the winning events, so they can correctly calculate the probability of success. And by setting also proper winning amounts to their slot machines, they can achieve positive expected profit and loss, and profitable outcome as a result. To make it simple, it is all just a matter of typical market behavior and risk management. Risk management is a critical aspect of any trading strategy. It involves identifying, evaluating, and controlling the likelihood and the impact of adverse events. Sounds pretty straightforward, right? But the devil is in the details. For traders, the calculation of the probability of some price movement for some asset is much more challenging. Most of the market participants use normal distribution as a representation of real historical price movements. Generally, on average, this assumption might have some validity, But when you're trading options, you are not dealing with the average behavior of some generalized stock. To the contrary, you are trying to build a successful trade for a specific stock that has its own price behavior. Translating this into a real-life example, how would you feel about going to the hospital for some condition and get treated on the basis of the average temperature of all the patients in the hospital instead of on your personal medical history? No one would find this treatment acceptable. The same happens on the markets when you calculate probability using a one-size-fits-all formula by assuming that underlying assets have a normal distribution. Look at this chart referred to the stock Tesla. What you're looking at in this image is a direct comparison between what Tesla should be doing according to the theoretical model and what it's actually done over the past year. The green histogram describes precisely the true behavior of the stock in sharp contrast, as you can see, to the normal curve, which is expected to effectively approximate the histograms themselves. Look at the tails of the distribution and tell me how much do you think you can trust the theoretical model. All this clearly explains why probability-based trading using a one-size-fits-all formula, which is relying on the assumption that stock pricing has normal distribution, can result in substantial losses. At Trade.ie, we bring a new, fresh perspective to calculating probability and managing risk. Our methodology stands out in a crowded field, providing a unique approach that sets us apart from all the others. Here you can find our approach to probability measurement. Our methodology is made of three components: price distribution probabilities, event-based probabilities, and technical analysis-based probabilities. Let me spend just a few words about each of the models used by Trade.ie, aside of theoretical probability based on the normal distribution. Historical probability takes into consideration the direction of the stock historical price moves and reflects the specificity of each underlying asset's historical behavior. Trade.ie platform provides probabilities based on historical price series from the short term to the long term, from 1 year to 5 years. Stress test probability looks at the magnitude of the stock historical price movements, not taking into consideration the direction of that move. Let's try to apply these logics to a real-life example. When a spring is squeezed from both directions, if you know which end will be released, you can safely decide which side to stand on. But if you don't know which of the two ends will be released, you'd better stand at a safe distance from both sides. Every trader likely experienced this. A stock is moving in one direction, then as soon as you step into the trade, it reverses itself. Since a stock has the potential to make large moves, traders need to be prepared for when that trade makes large move in their direction or opposite to them. Trade.ie introduces stress test probability to reflect the probability of surviving or ending up profitable in a trade when the underlying asset shows the worst historical case behavior against you. Stress test probability warns a trader about what can be anticipated by getting into a trade. So this allows traders to better understand their investment and set proper expectations. Let's now talk about event-based probability. All traders know that price behavior of a stock could be greatly influenced by different events that could expectedly or unexpectedly happen. It is very difficult and maybe even statistically unreasonable in day-to-day trading to take into consideration outcomes that happen during 9/11 or COVID-19 pandemic events. These and some other unexpected events inject some additional risk associated with any trade. Even if probability of stock behavior during these unexpected events could be difficult to quantify, our statistical engine and its ability to learn from the historical behavior allows to take into consideration reaction of each individual stock to general unexpected events. The great difference is presented by events that are happening with a certain frequency and thus could be predicted. One of such events is earnings announcements, for instance. Traders know that this kind of event ejects great volatility into prices. TradeAE's statistical engine allows to quantify results of these events by calculating probability of stock reaching certain price before and after earnings announcements. Earnings probability takes into consideration the specificity of each stock historical price behavior during and after earnings period. Then we introduce implied and historical volatility probability. Most of the traders active in the markets are using implied and historical volatilities in their analysis of the trades. TradeAE is enhancing this analysis by converting these volatilities into event-driven probabilities that allows adding one more important probability measurement to improve risk management of the trade. TradeAE uses a proprietary methodology for converting volatility values into functional probability values, allowing a multi-pronged approach to probability analysis. Finally, we introduce technical analysis probability. Many traders use technical analysis indicators such as the stochastic oscillator, the relative strength index, and the percent price oscillator to try and predict future behavior of the stocks. Each of these indicators have its own units of measurement, which makes it quite difficult to combine them all in creating analysis of individual stock. TradeAE developed a methodology of converting technical analysis indicators into the same units of measurement that represent probability. This approach allows adding technical analysis into probability analysis of the stocks reaching certain price point during some time frame. Finally, all our probability models are condensed into a parameter called success rate, which you will find everywhere inside TradeAE platform and represents some kind of weighted average of all the probability readings. Mitigation of risk is the key to success in trading. What we do here at TradeAE is calculating various types of probabilities so to be able to look at each trade from several different angles. Look at this picture. The trade considered here has all probability readings very high but one, the short-term stress test, which is good, but not as good as all the others. Normal distribution and long stress test probabilities also are not as high as the others. What does all of this imply? Here comes a very good anecdote that helps to better understand the specificity of option trading. Two travelers are walking barefoot in the jungle when suddenly a tiger starts running towards them. One traveler stops to put on his sneakers, and his friend asks him, "Why bother? You think you can run faster than a tiger?" The other traveler calmly replies, "No, but all I need to do is run faster than you." How does this relate to option trading? In option trading specifically, a trader always has somebody on the other side of the trade. If you are buying options, somebody has to sell them to you. If you are selling options, somebody has to buy them from you. In order to be profitable in options trading, you don't have to beat the market or outrun a tiger. The only goal you should have is to beat your opponent, the one on the other side of the trade. To achieve this goal, you need tools that give you competitive advantage in calculating risk and provide better expectation of the outcome of the selected trade than your opponent on the other side of this trade. None of our probability are better than the others. This is a key factor. What we have to look for, to the contrary, is just for values all lined up. This is what brings us the competitive advantage we need in order to be profitable in our trading. If what I try to explain to you about TradeAE methodology sounds compelling and resonates with you, learn from our Quick Start package that includes TradeAE tools with real-time access to market data, as well as a dozen of educational videos and one live Q&A seminar where we'll answer all your questions that arise after you will watch all the videos. You are going to learn the ins and outs of our methodology, and also I'll show you how to leverage our tools and to take competitive advantage versus the other market participants who do not have access to this platform. Thank you for your time. I look forward to seeing you at our live Q&A seminar.